please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Last quarter, they did about 13%, and that was the first time they did double digits since Q4 FY12, and that is because the previous year we saw a negative volume growth of 4%. So we had a favorable base, but here domestic volume growth of 11% when the street is expecting 6 to 8% is something that is pretty phenomenal, for the lack of a better word. That said, the net profit is still in line, so I'll await more details. But right now, volume growth of 11% is actually, it's quite cool. I mean, for the lack of, again, a better word, 11% is
the revenue
something that no one on the street was actually factoring in.
Oh, absolutely. In the morning, I was just wondering, we haven't seen a blockbuster number in a while in the last 1 or 2 weeks. This perhaps at that volume growth, they could perhaps qualify for that. 2048 is EBITDA, so that's also a handsome beat above what our poll was estimating. So the EBITDA is a very strong beat. Volumes are a very, very strong beat. The top line number that I have, revenue from operations, let's take a look at this. Total income is 9197. That's on the top line.
The number that compares with our estimates is the top line is 9,097,
okay,
if you must. So that's close to around 9,100 crores, and we were working with a number of 8,900 crores roughly. So there's a 200 crore beat on the top line. EBITDA, like you said, closer to around that 2,000 crore.
This is a top-down beat. It's just done phenomenally.
In fact,
well.
the stock is at a record high. And the company comes out with numbers like this. Not only numbers like this, a volume growth of 11% is quite a top-down beat, and coming in from the leader of the pack, it says something about the nature of this beast, because how serious is the company in terms of reviving its growth in the country. Because over the last few quarters, we did see some bit of disappointment from HUL. Just the last 2 quarters is where we saw improvement come by. And well, I believe we have an analyst with us right now. 11% volume growth, cost to Pavaskar of Sher Khan. 11% volume growth, 9,094 crore on the top line, as well as 1,350 crore on the bottom line. What do you make of these numbers, Kaustubh?
This is a sturdy performance. I think excellent set of numbers with 11% volume growth. My expectation for volume growth was about 8%, but 11% volume growth is, I think, beating the street as well as my expectation for the quarter. Also, operating profit standing above 2,000 crores is much better than what I was expecting. I was expecting about 1,950 crores of operating profit and about 1,331 crores of PAT. So I think PAT came much higher than what I was expecting for the quarter. So it's about more than 20% growth for the quarter.
Okay, all right. In the meanwhile, I'm also listening to reading out what the management have to say, that despite a step up in competitive intensity, we have delivered another strong performance. This is Harsh Manwani, the chairman, who's saying growth and improvement in profitability have been sustained through a combination of winning innovations, relentless focus on operational efficiencies. We're particularly pleased with our track record of sustained margin improvement for the 7th consecutive year. In the near term, we're seeing gradual improvement in demand, and this augurs well for the sector. Well, we have Abneesh with us as well. Abneesh, 11% volume growth, much above what the street was expecting. Even operational performance is higher. Just basis this quarter, the stock is at a record high. Do you see further scope for upmove on HUL, or maybe multiples will be maintained and it's the EPS growth which will drive the stock price higher?
I think clearly numbers are very strong. 11% volume growth is a multi-quarter high volume growth. And for a business in which 50% business comes from soaps and detergent, it is still tougher to get such a high volume growth. Even margins, they have done well. What we understand is because of GST, we saw Godrej Consumer also call out that they have started gaining market share from some of the unorganized players. The reason is, if you see raw material in soaps, etc., is internationally sourced. So already benefits have started. My sense is detergent also. And normally when inflationary conditions happen, we do see positive market share gain. So I would expect, yes, analysts to improve and increase their forecast for FY19 and 20. We'll also do that. Also, there's an analyst con call at 6 p.m. today. We'll have more clarity, but clearly very strong set of numbers. I would expect reasonably good performance of the stock in the medium term.
Okay, and this is despite the fact that, as Mangalam, you were pointing out and anticipating, they've really spent a lot on advertising and promotions, because those costs have really shot up year on year. They've done about 1,070 crores in the quarter that's closed, as opposed to just about 850 crores in advertising and promotions. Despite that, such a strong operational performance and margins on EBITDA. That's the entire top brass getting ready to address. Gaurang, let's quickly get in a comment from you as well. Are we going to see a big stock reaction? Because till now, the problem is that we've had great FMCG numbers, but stocks have been still muddled. But this one looks very solid, doesn't it?
It's very strong, and I was discussing this with Mangalam in the afternoon show at 2 o'clock and expecting a good run rate. I think rural commentary is something that we'll have to bank on, and I won't be surprised if that also contributes strong as we go forward from here.
All right. Increasingly, the management commentary has been positive. I believe the management has started addressing the media. Let's cut across.
From a demand point of view, we are seeing a gradual improvement, and that has continued during the quarter. Input costs continue to inflate in select categories and are primarily crude-led. Now let me talk about growth. In this context, we have delivered a strong volume-led growth. Our reported revenue growth was 3%. However, after removing the accounting impact of GST, our comparable domestic consumer growth was 16% with 11% underlying volume growth. Our comparable EBITDA margins expanded by 160 basis points, and our net profit at 1351 crores was up 14%. Let me talk a little bit about our categories here. Home care delivered a double-digit volume growth. In laundry, all our key brands grew in double digits, and household care growth was led by Vim. Laundry also saw the launch of Comfort Pure, a fabric conditioner for delicate baby skin. In personal care, the growth was broad-based and across both personal wash and personal care. Growth in skin care was led by FAL and Pond's. In hair, the growth was broad-based and volume-led. This quarter also saw the launch of Pure Derm, our new anti-dandruff range of shampoos. Color cosmetics sustained its robust performance, continuing a strong performance trend. In deodorants, we launched Axe Ticket, a new pocket-sized perfume pack, and extended Rexona antiperspirants nationally. In personal wash, the premium range continues to perform remarkably well. Growth in popular segment was relatively muted. Moving on, foods witnessed good growth led by ketchups and soups. Refreshments sustained robust delivery yet another quarter with double-digit growth in tea and strong volume-led growth in coffee. Ice creams and frozen desserts also saw double-digit growth on the back of geographic expansion and some exciting innovations heading into the season. From a drivers of growth perspective, I think it continues to be our relentless focus on innovation, impactful 360 degrees activation, and a sharper in-market execution. Sustained market development in emerging categories like fabric conditions, green tea, natural care continue. And we continue to invest behind our brands, both from an innovations point of view as well as exciting activations. So when I look at it from a profit and loss point of view, our EBITDA grew by 24% and our comparable margins by 160 basis points. Cost of goods sold was down on a strong savings program. Net profit after tax before exceptional items stood at 1,409 crores, and which was up by 26%. Net profit, given some exceptional items in the quarter, was up 14% at 1,351 crores. We'll also talk a little bit about our full year performance. For the financial year 17-18, our comparable growth after adjusting for accounting impact of GST was 12%, with an underlying volume growth of 6%. Our reported revenue, for the said reasons, would be lower at 2%. Our comparable EBITDA margins for the full year expanded by 155 basis points, and our profit after tax before exceptional items stood at 5,135 crores, which is up 21% year-on-year. Net profit at 5,237 crores was up 17%. From a dividend point of view, we continue to reward our shareholders, and the Board of Directors have proposed a final dividend of 12 per share for the year ended 31st March 2018, up from last year's rupees 10 per share. Looking ahead, we expect gradual improvement in demand to continue. Input costs are likely to inflate further, given crude, and currency is the other key watch out for us. With trade normalizing and demand improving in the near term, we anticipate a step up in competitive intensity. Our strategy remains unchanged. Our focus remains on volume-driven growth and improvement in operating margins. We will continue to drive growth which is competitive, consistent, profitable, and responsible. Thank you.
One at a time. One at a time. No, I think I saw that hand go first. So one and then two.
First of all, I want to talk about the volume growth. 11% is the kind of volume growth that you come up with. The street was expecting anywhere between 6 to 8%. Firstly, I wanted to understand what has really driven volumes specifically for this quarter, because we do understand the last quarter there was a low base effect. And second, in terms of rural growth, what are your expectations on rural growth? Is it back to historical growth levels? Because 2 times of urban growth is what we've seen in the last few quarters.
Yeah, first, if I just pick up the rural growth, I think the good bit is that the rural growth has again come back. There was a period of time when the rural markets were growing less than urban. So I'm very happy to tell you now there are pockets where they are growing ahead of urban, not at the historical rate of growth, 1.5, 1.6x, but clearly there are green shoots that rural is up again. And the other important bit is we should also thank the government. The steps they took to reduce the GST rates and growth 1.5, 1.6x, but clearly there are green shoots that rural is up again. And the other important bit is we should also thank the government. The steps they took to reduce the GST rates and the way we as Hindustan Unilever reacted by passing on the benefits to the consumer, that also I believe has played an important role in fueling the volume growth. But when you look at our performance over the last full year, delivering 12% top line growth, 6% volume growth, and a decent increase in EBITDA margin, I think this stems from what we've been doing over the last few years, focusing on the core, driving penetration and the distribution, ensuring that we have multi-year engagement platforms on the brands to build the brand equities, focusing on execution excellence on the ground to improve the quality of distribution and the assortment. Yeah, all these things put together, and of course, the lifeline of FMCG companies, innovations. We've had some very successful innovations and a thrust on market development, which is developing the category of the future. All this has played a role. And then, of course, has been a focus on removing non-value adding costs from the system. That has given us the fuel to grow, which we have invested back behind the brands. So all this put together has resulted in what we would like to believe is a very satisfying performance.
Sir, by when do we expect rural growth to go back to 1.5%, 1.5 times of that of urban? And also, which are the pockets that have witnessed, that we've seen that is outpaced urban growth?
See, we would not like at this stage to call that a trend has been established. Yeah, like all of us in the country, we would like rural India to prosper. Yeah, over the last few years, there was very clear stress in rural India. We know about that. The wage rates were low and the MSP increases were low. You have seen that the government has reacted, and in a very positive way, they are determined to put more money in the rural areas. That, together with us lowering the price consequent to GST, should help the cause. The other big leg, of course, is the monsoon. From all indications, the monsoon should be normal. So all this should augur well for rural areas. I would say just wait for a couple of more quarters to see whether the trend is really coming through.
As far as input prices are concerned, we're seeing the crude prices gradually increasing. What is the kind of impact that we can see in that?
We have always explained there is no one-to-one correspondence between input price and our selling price. First and foremost, our focus is on consumers to ensure that we maintain the price-value equation. We look at all lines of P&L. We look at all the levers in the P&L to play the game. Our relentless focus on generating saving, reducing our cost base, we try to ensure that we minimize the impact to the consumers.
You understand that you have taken about 2.5% hike in it.
Yes, now if the prices go up, you can imagine that the fuel prices, they were very low last year. There has been a significant increase now. Rupee has also depreciated. So there would be an impact on the cost base. But our endeavor would always be to maintain the price value equation.
I think to contextualize that, just to add to what Sanjeev said, if you look at crude itself in the last one quarter has moved up by 20%. Currency has moved up by 6 to 7. And I think you'll have to look at contextualize it with what price increases in particular categories Sanjeev has spoken about, and then start to put into play how savings are enabling us to manage the full portfolio.
Yeah, and the important thing here is portfolio. Because it's not that we do, as Sanjeev says, one-on-one price increases on every part of our portfolio. We also see where is it that we can afford to take some pricing in terms of maintaining a degree of competitiveness, where is it we believe that our consumers will benefit or our market development efforts will benefit out of maintaining prices. So it's a combination of all these factors.
So, sir, in the previous quarter, which areas were the growth drivers for you? Because
you would have seen from what Srini talked about, the wonderful bit has been across all profit centers, whether it is personal care, home care, foods and refreshment, we have had double-digit growth. And again, we have been it has been widespread. Yeah, but what gives us competitive advantage, if you have been tracking Hindustan Unilever, first is our winning in many India strategy. And second is, we have brought in huge agility in the business through what we call the CCBT structure, country category business team. So this has unleashed not only huge energy, but has made us much more agile. So this too, I would certainly believe, have played a role in HUL's performance during the last.
So you cannot have a performance that is like this unless it's fairly broad-based. There will be differences, but at the end of the day, it is broad-based. Sorry, there was one other question here.
Just a continuation on the first